You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody, welcome back to the Advisor's Option, the program here on the Options Insider Radio Network, where we break down all of the compelling ways that you, the busy financial advisor and asset manager, can utilize options in your client portfolios, as well as, of course, all of the breaking developments and news from the world of options that may not have filtered over to your side of the fence. Of course, you guys are busy doing what you do, managing your clients' money, so it's our job here to fill you in on what's going on in the world of options that may impact and indeed interest you. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the aforementioned Options Insider Radio Network, and it continues to expand. We're up to 14 programs now on the network. The latest edition this week in Futures Options, as the name implies, that program breaks down all of the latest developments in the world of futures options. So if you're interested in crude oil or metals or even soybeans, a big hot product these days, then check out that program where we break down all the latest there. You can find that wherever you find your favorite Options Insider Radio Network programs, including, of course, our website, as well as iTunes and TuneIn and Stitcher and the new Google Play podcast store and a variety of other outlets, including, of course, our mobile app as well. It's all available there for you as well. And if you're new to the program, I encourage you to go check out some of our great archived episodes of the Advisor's Option, where we talk about a lot of great topics that are certainly relevant to you, the active financial advisor and asset manager, as well. For those of you out there, maybe you're looking for a new financial advisor or asset manager and you want to know what kind of skills they should bring to the table. Don't worry, we've got you covered on the Advisor's Option. And joining me on the program today is my cohort, my co-host here on the Advisor's Option. He is Randy Swan, the co-founder of Swan Global Investments, beaming in from the tropical paradise and also fiscally healthy area of the world known as Puerto Rico. Randy, welcome back to the Advisor's Option program. It has been too long.
It's great to be here, or to be on the show again. It's been, I guess, a couple months since you actually came down and we're at our CAO conference, so I think we're going to talk about that a little later. It's not sunny so much the last week or so. It's actually been rainy. It seems like our wet season has begun a little early this year.
Well, you are a few feet from a rainforest over there, are you not?
That's true.
So that probably has something to do with it, I would think, as well. But you're right. It has been not that long since the old Swan CIO conference. So let's get into that and a lot of other breaking news in the world of options and indeed options-oriented events for advisors with our The Buzz segment.
Busy financial advisors don't have time to follow the latest developments from the options market, so we do it for you. It's time to get The Buzz.
All right, everybody. Welcome to The Buzz. Like the name implies, this is indeed the portion of the show where we catch up on some of the latest developments in the world of options and tell you how they can really impact you and your practice. And a lot has been going on since the last time we all gathered here together on the old Advisors Option Program. Randy, it hardly seems like it's been nearly 2 months since the big CIO conference, the big Swan Global CIO conference there in Puerto Rico, but that was early April 3rd, if my memory is correct. So we're coming up here recording this at the end of May. So we're coming up on 2 months from the big Swan CIO event. I encourage you listeners, if you haven't had a chance to check out the episode we recorded down there in sunny, at the time, certainly very sunny, Puerto Rico. It's our last episode, so go check it out. We sit down with a lot of the team from Swan, talking about a lot of the interesting takeaways from the event, some interesting nuances, conversations, topics of discussion from the event, and all the people who were there, as well as some interesting data coming out of the event. So check that out if you didn't have a chance to make it down to Puerto Rico. I think you'll find it interesting. But Randy, one thing we haven't had a chance to do is kind of get your perspective. You're the guy who kind of helped, spearhead this whole thing. It was your idea to kind of have this type of event. It was the first big Swan conference of this type. So first off, I'm curious for you, what are your immediate takeaways from the event now that you've had a few months to kind of process it and settle down from the high of having a big event like that? What are your immediate thoughts on the event, your takeaways from it, interesting discussions and takeaways? And then also maybe if you guys are planning a Swan CIO 2, and I don't want to put words in your mouth, but I think you are, then maybe what are some interesting things you learned from this event you may want to apply to the next event?
Sure. Well, I think overall, since it was our first event like this, I think it was hugely successful. We got a lot of positive feedback from the participants that went there, as well as a lot of the people that were sponsors. And so we're absolutely going to plan on doing it next year. Before I get into that aspect, let's talk about some of the good takeaways from the event. I mean, I think fundamentally people go back to the same problem. What are people going to do about yield? What are you going to do about the fiscal situation that exists in this country? So I think that's always where people are looking at ways to figure out how we're going to solve that problem. And of course, why we had the conference in the first place is to introduce to a lot of these new potential clients of Swan the concept of hedging and options, and so that's why we had such a big part of the conference that had a lot of good background. We had various members from different exchanges and brokerage firms, et cetera, to talk about the different issues and the scalability and how the option industry has changed over time. So from the big picture perspective, I think those are a couple of the key takeaways. We obviously had a lot of our own internal research that talked about math matters, which was a good aspect of that, and solving the Gordian knot. And that goes back to some of the challenges that most advisors face today. So overall, like I said, it was a big success. How we're planning on moving forward, I think we're doing two things right now. One is we are going to take that conference and condense it to about a half to two-thirds of a day. And we're going to do that in various places around the country throughout the end of the year. We're calling it the DRS 22 meaning the number of mini conferences we're going to have throughout the year, and really allowing people that could not come or other people that had not known about this to be able to visit on a smaller scale, something like this, and participate in their region. So anyone that's interested in that can contact us about where that's going to be in your area. Coming to your area soon, I guess, is the best way I would look at that. Next year, we're definitely planning on doing this again. We haven't decided when or where, but probably be in early spring next year. We actually kind of put this together in about 5 months for this year. So this time we'll have a little more time, and I don't know if we'll do it in Puerto Rico or not. But generally speaking, I guess, Mark, I'd like to get your thought on how you like coming down to Puerto Rico, and did you like the location?
It was a great place. You've always joked about recording the show down there, and we actually got a chance to finally do it, which was fun. Always fun to record the show with the breaking waves of the ocean right outside the resort. It was interesting timing, of course, to be in Puerto Rico, because it was kind of right on kind of coming into all the big debate that's going on right now over there about the financial situation over there. So talking to some of the representatives from Puerto Rico down there as well was kind of interesting and enlightening to get their perspective on how everything is unfolding over there. And also it was just an interesting opportunity to get a lot of people together. You don't normally get together at these types of events. The CIOs and people who represent a lot of the firms and vendors who speak to that audience, because obviously that's an interesting audience for us, is one we've been targeting for a long time with this program and some other initiatives on our network and on the website. So getting a chance to get all those guys together in the room in one area is always an interesting opportunity for us to kind of just pick their brains on the issues of the day. And certainly at the conference, it was really coming right into the result. The decision was coming soon, so it seemed like one of the big issues of the day at the conference was indeed the Department of Labor proposal. Everyone was kind of waiting on pins and needles to see how that would shake out. If you recall at the time, we had talked about it, of course, many times on this program over the past, seems like going back almost a year, even though it's been a little less than that, but it seems like it's been many years just from the length of that discussion and that debate, how long it kind of dragged on. And it seemed like the Department of Labor initially got the criticism and the feedback, and they weren't going to cause the issue, and then all of a sudden it seemed like they maybe changed their mind and they were going to go with the language that prohibited options. So coming into your event, Randy, it was kind of an interesting time to have that audience all together, because everyone was kind of waiting for the results. Of course, we've since seen what the Department of Labor came out with. If you haven't been following along with that, listeners, effectively what they did as a result of a lot of lobbying from the industry and other firms is they removed the language that had effectively eliminated the use or banned the use of options in IRAs, which was, of course, a big concern for certainly a lot of this audience, because so much of the use of options comes from IRAs. I've seen different numbers, different studies. It's kind of a ballpark figure. Ballparks anywhere from, about 5% to about 15% of ADV, depending on the day and kind of what names you're looking at and things. But either way, it's probably ballparks. Average is probably closer to around the 10 plus range. So it's a substantial amount of ADV that would effectively go away. And certainly for a lot of this audience, that's their primary use case, is in retirement-oriented accounts. So that would eliminate a huge use of options for a lot of this audience. So it certainly was a very, very contentious issue. And now, of course, in I think it was the week right after your conference when we finally heard the ruling. So I'm curious for that as well. We haven't had a chance to talk about this since your event, Randy. What are your thoughts on the ultimate ruling? Are you kind of satisfied with how it turned out? You think the danger has passed, or do you think there's still a little bit of room for tweaking and improvement in the language there?
Well, I guess I'm generally happy. As we've talked about numerous times, I mean, we think more choice is better, more freedom is better than none. I think the good side is, obviously, they didn't do anything to limit the use of options inside of retirement accounts. I think the bad news for me, just the way I see things going, and this is not something that I can point to and say, oh, I know exactly what's going on, but I just sense that this is part of a longer-term play by the government to really kind of control and track and potentially get their hands in the cookie jar about the whole kind of retirement industry and getting into people, how they're going to manage money and what they want out of this. So I just, like I said, I've had some conversations with people that have kind of brought up issues like that. It makes a lot of sense. I think this thing is not necessarily going to go away. And I'm not particularly talking about the option side, just in general about government, more control of the entire, let's just call it individual retirement account space.
Yeah, I definitely agree. This is probably the tip of the iceberg. In fact, I do believe if we get to it later, we have a listener question about that exact issue and the qualifications or perhaps lack thereof that it requires to become a financial advisor in the modern era. That's all. So I think there's definitely the more hand of regulation, more oversight, and more people just becoming aware of really what's been going on kind of behind the scenes in the financial advisor and asset management and investment space for a long time. And even the Department of Labor proposal, like a lot of these things, they come from a good place. They come from an attempt to really try to clean up the space, get rid of the bad actors. What we see a lot in the option space, in particular, a lot of the unintended consequences, they didn't really go into this, I don't think, intending to ban options. At least it didn't seem that way. It seemed like an error of omission rather than intent. But that's kind of what happens when you start creating lists of things that are allowed and not allowed. Things that aren't on the list have problems. Things that are on the list may cause problems. So that's always the unintended consequences of this stuff. And as usual, the options crowd, the options market gets lumped in with the unintended consequences. Hey, before we move on really quickly, Randy, you mentioned, I'm still kind of trying to wrap my head around this. You guys are going to do 22 mini conferences towards the end of the year. Wow, I guess more power to you and your events team. That's an impressive number. So if our listeners want to learn more, even before we get to the end of the show, if they want to learn more about where you're going to do these, as well as I know you guys have some of the materials from the April conference on available, where should they go? What should they do?
Well, first of all, as it relates to the future conferences coming up, I think the best thing to do is send a request or call up Swan, and we can get you directed to the right places going forward, and when it's going to be in that region, and we can have someone contact you directly. I think that's probably the best way to go. As it relates to actually getting some of our information from the conference we've already had, I've got 2 websites. One of them is swanconferences.com videos-slide-show / and the other one would be swanglobalinvestments.com. There's some stuff on our thought leadership page or our main website. So those are the two details that I can give you, and I may have some more stuff later, but I know that we're still doing a lot of editing and trying to fine tune it and make it as efficient as possible to get some of these videos, but absolutely willing to share these videos to the general public.
Yeah, I'm looking at it right now as you're talking. Yeah, easy listeners, just go over to swanconferences.com, and then it's all right there. You can click on the videos tab, but you can click on the guest speakers tab information. So if you want to see some of these sessions, maybe you didn't get a chance to see them, you want to see some of the presentations or indeed the actual videos of the talks, and some of them are pretty interesting, then surf on over to swanconferences.com to check it out. Speaking of conferences, Randy, I think one of the reasons it doesn't seem like it's been almost 2 months since your event, since I know I have, and you probably have been as well. In fact, I know you were, because you and I ran into each other, not in Puerto Rico, but on the other coast, on the other side of the country, over there in LA a couple of weeks ago. I was out there for the big Options Industry Conference. You were out there for the big OIC Financial Advisor Conference. Unfortunately, Eric from the OIC team couldn't join us today. He's gallivanting hither and yon, as those guys are wont to do. But that's their big annual conference for the financial advisor audience. And by the way, if you haven't had a chance to check it out, listeners, head on over to wherever you find our programs. Our network show is probably the easiest way, but also our Options Insider Radio interviews program. You can get all of my interviews from that conference, including my sit down with Eric, where he and I kind of chat about his takeaways from the event and some of the interesting discussions and panels and debates and topics they had at that financial advisor conference. If you're an advisor, you're interested in options, that's an event I think you definitely want to check out. And Randy, I know you were out there. You were attending the event and speaking, I believe. Give us your thoughts on the event. It seems to be growing and evolving and changing to reflect the needs of the space every year. So what were kind of some of the key themes of the event this year? What were some of the interesting topics and things you may have come away from that big OIC Financial Advisor Conference from this year, just a couple weeks ago?
Sure. I had three takeaways from the event. One, I really liked the Dorsey Wright presentation. It really got into the concepts of using different momentum indicators on whether it was stocks, sectors, or the market in general to use different types of option strategies. Obviously, in an overbought market, you may want to be selling a closer at the money covered call type of strategy or a hedge strategy versus going long or doing bull spreads on markets that are severely oversold and due for a correction. I like that part of the deal. They had a whole entire section on the whole concept of option overlays and the customization. Of course, at Swan, we do a lot of that at Swan, so we love that kind of panel. And they just had 3 panelists that talked about their own individual practices and how they handle mostly a lot of Silicon Valley high tech, small concentrated positions, but how to handle those types of clients and relationships and what type of consulting engagements they get on that. I thought the most interesting part, and this has nothing to do with obviously investing or options, is that we had one political consultant and one political professor. I think it was from UCLA. Their take on the coming up election, the presidential election, and how they see this playing out. I think the most interesting part that I actually had, and I talked to the professor after she got off the stage, and she we asked her point blank what was her thought on the whole Hillary Clinton email scandal and how she thought that was going to play out. And interesting enough, she attached almost a 0% probability that something really was going to come from that. And I thought that was pretty amazing that that someone like in that background would actually say that. And that, when someone usually puts such a low probability or a 0 probability of something, that tells me that people are misevaluating the facts and circumstances, and that risk is much higher than what people are saying. So that's kind of my contrarian play of the week, I guess, is she didn't seem to think that was even something worth even talking about.
That's your contrarian pick. Always going to go down for the email scandal. But you're right. I did attend a conference a couple months ago, and they had another similar political analyst there. I think someone asked him a similar question at the time. How do you rate her different probabilities of things happening to Hillary? And he was kind of like this other expert. I didn't get a chance to see her presentation, but he said essentially along the lines of he had her probability of winning versus Sanders, and then he had some other kind of rogue probabilities thrown in there. One was, I think, her having some sort of a health issue that pulled her out of the race, and in his rankings, that was actually a higher probability than the email scandal kind of coming back to bite her. I think he had that, and then he had like a third-party candidate coming in and kind of stealing her thunder. Were kind of tied and still above the email thing. So yeah, a lot of people who are quote unquote in the know apparently seem to be writing this thing off. So maybe that factors into your known unknowns category where people are, you're right. Maybe they're underplaying it. Maybe there's some way to if you could hedge that tail risk if you were Hillary somehow and buy some puts on that, it might be a good play because they're clearly undervalued right now. You can get them really cheap. No one's pricing in that risk.
Yeah, absolutely.
Let's a couple other things that kind of caught my eye here in the buzz segment before I know a lot of you guys, we haven't had a chance to get on the air in a little while since Puerto Rico. So I want to make sure you guys get some time, get some love on the old show as well. And you guys have been writing in en masse. A couple other things that were catching my eye from a content perspective. This one actually comes from courtesy of your newsletter over there, Randy, The Good, the Bad, and the Ugly. You guys put out there on a regular basis. If you guys want to check it out again, the Swan Global Investments site, probably the easiest way to find all that. They actually have some decent content. If you want to just surf around and check out the blog. Of course, our radio stuff, I forgot to mention at the top of the show, you can also find the radio show there on the website as well. So again, I'm certainly a fan of the radio side, so check it out. And the blog, in fact, I was looking at, I think Mark, who's been on the show, Mark Odo, had a write-up about the Delta, explaining Delta and breaking down the Greek. So that's an issue that's been of concern. If you're interested in kind of the Greeks a little bit more detail, maybe that's something you might want to check out there as well. But what caught my eye, Randy, you guys have that appropriately named Good, Bad, and the Ugly newsletter. And something I pulled out from the Ugly section kind of caught my eye. I thought it was worth discussing here on the show. And that is effectively, we all have this kind of beaten into our heads from an early age. Certainly whenever you start studying finance and economics on the university level, they start beating into you these notions of long-term average rates of return for the various markets and indices, and they kind of just pass these things down to you as if they're gospel, essentially. Hey, this is what you can expect over the long term if you buy and hold in the S&P or whatever the case may be. And your little nugget here from the Ugly kind of caught my eye. It was called, they were actually citing, or you guys were citing an article by firm Crestmont Research, and it was entitled "Waiting for Average: Why the Long-Term Average Will Never Occur for Today's Investors." And I encourage you, research that or just click on the newsletter and you get the link there as well. They kind of break it down in a lot of different ways. What's been bandied about right now, the long-term average is 10.1%. That's the long-term average return going from 1926 to 2015, so a pretty lengthy time period. And there includes a few, shall we say, downturns like 1929, 1987, 2008, et cetera. So the long-term average there from Ibbotson and published by Morningstar, 10.1%. But if you break down that 10.1%, it comes in a couple of different chunks. Earnings growth, as you might expect, kind of the largest driver there, about 5.2%. About half, roughly, of that 10.1%. Increase in PE ratios only contributed less than 0.5%, so not that big of a driver there. The rest, dividends, surprisingly enough, about 4.3% of that total 10.1% of the long-term average return coming from dividends. And they go on, again, you can read the whole article to kind of get the full nuggets, but they kind of claim that it's not likely PE ratio is going to really expand that much more. Earnings growth higher than that 5.2% doesn't seem to be particularly likely given the current scenarios and what we're seeing for the future. And dividend yields are about half of what their historic average has been. So kind of add all that together doesn't really spell out a long-term path to that 10.1%. So maybe we are kind of misleading ourselves with that. And that kind of also, it feeds back into the options conversation again, Randy, because again, if dividend yields aren't growing, what can you do with that? Of course, you can create your own dividends using options, something we talk about a lot here on this program, and some of the other ways you can use options to enhance some of that. So I'm curious, Randy, your thoughts on that. It certainly is kind of interesting. Again, I encourage our listeners to click on the link for themselves to see all the data. We don't have time to get into all of it right here. Kind of interesting stuff, and it kind of is an interesting counterpoint to something that I know I certainly was, and you probably were as well, kind of had beaten into our heads at a very early age from a financial education perspective in terms of this is kind of what the market does. This is what you can expect if you buy and hold over the long term. Maybe not so much the case, Randy.
Well, obviously, I chose to put that in our quarterly newsletter because I thought it was very straightforward. It really wasn't that long of an article because it kind of explains itself. I mean, and I think the underlying premise is very simple. We've had an expansion in PE ratios over that that time period. Earnings growth are nowhere even close to that. I think our economy is growing now at less than 1% per year. And obviously the dividend yields are really hard to get back to that. And I would say when I kind of put all that together, besides the obvious of saying, hey, you're not going to probably get your historic average, you're left with really, what kind of expectation should you have going forward? The author of this kind of points out 6% best case scenario. I think the kind of 2 to 4% to me is much more logical just based on where we are in terms of growth rates. But I always go back to, and beyond the comment you made about how we can kind of manufacture income in an environment where there's not a lot of opportunities, I go back to the concept of, hey, if there is going to be a 2 to 4% kind of return for markets over the next, 10, 20, whatever years, it's probably not going to be 2 to 4% per year. It's going to be, 50, 60, 70% sell-off somewhere along there and then struggling to get back to square one, kind of like I think we've done, obviously, to a lesser degree over the last, 10 years or so. So that to me is where the whole concept of option income as well as hedging allows you to try to get something that's much closer to those types of returns in a market environment that's not really going to get to that level. And so we always have used that as one of the points in our kind of sales approach is, hey, Dallas 36,000, how realistic is that? Well, not really. But you don't have to have a Dow 36,000 to reach your goals if you're not a long-only manager or a superior stock picker. So I would look at it and say, and having a 50, 60, 70% sell-off over the next 2 or 3 years and then a subsequent rebound to where we are right now is actually gives you, if you are in a hedge strategy, it gives you the opportunity to get returns that are closer towards what you really need. And then I would just finish that comment off by Mark Otto and his solving the Gordian knot is kind of goes back to that principle of, hey, with the fixed income yield so low right now, stocks need to return not only 10%, but 12% to get back to your traditional return on a kind of diversified portfolio. Makes it harder and harder to get there. And we're not going to get into the risk level, obviously. That's a whole other concept.
Yeah, it's a lot of interesting stuff. Again, check out the link for the full details on that. I guess this is kind of the dark side of Warren Buffett's success there, Randy. Everyone thinks they can just buy and hold, and it all kind of works out in the end. And, of course, we here on this program and indeed on the network and at the Options Insider advocate for a little bit more active approach, shall we say. And again, I think it works out over the long run. Real quick, I know I want to get to your listener questions in a second too, listeners, but I got a couple other nuggets that kind of just tickled my fancy here. Coming out of, again, this is, you guys have some little random economic facts you throw out there at the end of the newsletter, and I wanted to kind of just, a couple of them caught my eye. Again, not options related, just I think kind of fun and or interesting. Well, number one, Coca-Cola is fighting 12 consecutive years of soda consumption decline, but its stock is at an all-time high. Tesla is changing the world, in quotes, and orders for his new car are off the charts. The stock is lower than it was 18 months ago. Again, this is from the end of April, so the numbers may have changed a little bit, but mostly still relevant there. Cigarette consumption has dropped 44% since 1981. Altria stock is up 71,000%. Since 1981, Walmart net income has tripled. Since 2000, its stock has lost 1.5%. Since 2000, Apple has earned almost $250 billion of profit. Since 2012, stock has barely budged. Amazon's profits round to zero. Since 2012, its stock has tripled. Again, the ongoing love affair with Amazon. 2009 was one of the worst years for the economy in a century. The market rose 27%. that year. 2015 was a good year for the economy. The market rose 1%. Brazil's economy is a disaster. Stock market is flat over the last 2 years. Let's see. America is enjoying the longest streak of low unemployment claims in 4 decades. Its stock market is also flat over the last 2 years. I don't know what comments you might have on these, Randy. These kind of just caught my eye. I guess you can call them, economic comedy, for lack of a better term. But they do kind of raise some interesting ways that we look at the market versus perhaps the way things actually are out there in the marketplace.
Well, sure. We put those in there for the sole purpose to show how much folly it is to go out there and make these grandiose predictions of what you think is going to happen. And I use the analogy always to this day of, the whole irrational exuberance speech by Greenspan in the fall of '96, yet the market still took 3.5 years to top out. And of course, he was the smartest guy in the smartest room. So just shows you that sometimes having a superior strategy that doesn't rely on you to be the genius that you think that we all think we are is sometimes more valuable than the going the other way.
Speaking of going the other way, it's time for us to go the other way and let you guys take the reins. It's time to open up our office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, everybody. Like the man said, this is the portion of the show where you guys get to join Randy and I on the program with your questions, your comments, and as usual, you guys brought it in you guys bring us a lot of interesting different directions here on the show. That's why I appreciate your feedback so much. Let's start with a question from Njord. I'm not sure how you pronounce that. He or she wants to know, I would like the hosts, I think, here to express their views on the following article. Is it time to raise the bar for becoming a financial advisor, and how do options play into this? He included a link in his email to an article on the Wall Street Journal. Listeners, came out, I believe, early April. It was entitled, you can look for yourself, How Come It's Still Harder to Become a Hairdresser Than a Financial Advisor? And this column by Jason Zweig raises a lot of interesting points. He refers to a survey they took of 500 investors and kind of asked them, kind of getting back to that point we were raising earlier, Randy, about the kind of digging into the fiduciary obligations a little bit more. This article kind of gets into that, who has what different types of fiduciary obligations. That's interesting in and of itself, but the point that caught my eye, I think it was kind of interesting what he references in the title, is people also in that same survey dramatically underestimate, really, or I should say overestimate, how much education is required to actually become a financial advisor. This study, the professors who conducted this study also had some other interesting nuggets, saying the professors wrote, in the most states, the minimum level of education needed to become a broker or an investment advisor is lower than the education requirement needed to become a hairdresser or an electrician. Electricians are required to complete several years of apprenticeship work under the supervision of a licensed electrician, while brokers and investment advisors face no such requirement. Most states do not even require a high school diploma or a GED to become a broker or an investment advisor. And they also say no minimum education requirement exists to qualify for the Series 7 or Series 65. Many people who work one-on-one with clients do not attain any education beyond this level. According to the study, 71% of respondents believed that a college education was a prerequisite for being a broker. Again, they were all incorrect. 85% of them believed that an investment advisor was required to have at least some college education. Again, they were incorrect. The study's authors conclude by saying it is disturbing that regulators seem to expect a high school dropout who has passed an exam designed for entry-level professionals to have the education, training, and experience to know when an investment decision is in the best interest of the client. The article concludes by saying professions like accounting, law, and medicine took decades, often centuries, to advance to the point of requiring rigorous education and licensing for all of their members. The field of investment advice remains a long way from being able to call itself a profession. So kind of a scathing critique here, Randy, but they do raise a lot of very interesting points I would mention to you, this is something I've kind of had an issue with for a long time on the financial advisor space as well. Something that I've been pushing and advocating for myself and here at the Insider for some entity within the option space to try to rectify this by providing some sort of additional level of education and or certification for the options component that we're always talking about. And it started getting some traction. Then it seems like post Bernie Sanders, a lot of exchanges and other groups like the OCC, who partnered with us on this program, lost a little interest in that. Not really hard to understand why. The liability associated with certifying anyone in any product these days is pretty substantial, and a lot of lawyers kind of shy away from that. But that said, if you listen to my conversation I had with Eric coming out of the Financial Advisor Conference, they are starting to tilt a little bit that way again over there at OIC. We'll have to get him on next show. He can talk about that a little bit more. They are coming out with a certificate program. It's going to be, I think, a 2-day program at some other conferences. So again, it's a baby step in the direction that goes along. Doesn't go anywhere if you don't even have a GED. It's not going to solve the problem. But at the very least, it's going to start, hopefully, starting to push more of these professionals in this space to getting into that. And Randy, I've always viewed options as kind of the counterpoint to this anyway. I mean, a lot of the guys they're lumping into this kind of group are probably the kind of generic wirehouse kind of 60-30-10, 60-40 guys who you come into their office, they say, how old are you? What's your risk tolerance? Okay, here's my spreadsheet. Here's what you should invest in. That's kind of all the work that they do. And that guy, the monkey, could do that job, quite frankly. That's why things like all the fintech startups are starting to eat into the robo-advisors, starting to eat into that space. But options have always required a little bit more nuance, a little bit more understanding. So almost by definition, if you go to an advisor who utilizes options, I think you could reasonably expect a little bit higher degree of sophistication as a result. But that said, I'm curious, what are your thoughts on this somewhat scathing critique of the financial advisor industry and how we still have a long way to go to even catch up to hairdressers, Randy?
Well, I guess I would describe it in a couple ways. I mean, I think first of all, my background actually as a CPA, I think it's kind of relevant because it gives a good example. I think that they mentioned in the article. I think to take the CPA in the state of Texas, I think I had to have 150 hours, an advanced degree, obviously pass the test itself. So that's pretty rigorous compared to the analogy that you're using here, where someone that doesn't necessarily have to do all that stuff. I don't know the studies on what kind of, on average, these types of education levels that the average broker dealer or wirehouse guy or even the advisors. I mean, I deal with, quite frankly, the entire spectrum of people. And I'm not saying uneducated people, but I'm just saying the different levels of sophistication in my client base, because we literally have hundreds, if not thousands. I guess we do have thousands of clients, advisor clients that use our products. So from my personal experience, I would just like to say that I'm sure a lot of people are a lot more qualified. I just don't know how many people out there that don't even have any type of college education. It could be true, though. I guess the way I always go back to, it's kind of like getting a bad haircut. I think obviously since the article talked about being a hairdresser, ultimately if you don't have a good haircut, are you going to go back to that person? Or if you don't have good experience, obviously, advisor may take a little longer to find that out than immediately upon your haircut. But I think the same thing applies. It goes back to the robo-advisors. Long term, you need to provide value to your clients. And I define value as you're going to help those guys make better decisions, to stick to a plan, provide a lot of financial planning type stuff. Is really what you should be doing if you're that type of an advisor. And so, how much of that knowledge and how much you picked up in education. I mean, the point is, the point is 100% valid. They probably should have higher standards, but I just don't know if the average broker dealer advisor doesn't already have that anyway. That's all I'm going to say.
Yeah, it's interesting. We're so awash in regulation and increasing regulation, and it's kind of just the order of the day in the business these days. And yet, something like this, you can still kind of sneak by without even a GED. It kind of is starting. I agree. It's probably a very small actual percentage of people out there who don't even have a GED who are acting as financial advisors. But still, it does kind of call into interesting relief there, the potential for that to kind of happen, which I think would be alarming to a lot of people. Again, a small study, small sample size, but the points, I think, are more interesting. You can check out that article for yourself if you want to read it. I believe the article you refers to is called "How Come It's Still Harder to Become a Hairdresser Than a Financial Advisor?" Great question there. Move on to another one. We got time for a few more here. This one comes from JBigg. He writes, this kind of goes back to what we were talking about earlier here, Randy. He writes, does the presidential election cycle have any notable impact on the options market? This is an interesting one, kind of interesting challenge to address. You've been doing the DRS for quite some time. You've been using options for quite some time. In my memory, Randy, the election cycle that kind of stands out to me as just the apex of injecting volatility into the marketplace was the 2000 Bush-Gore kind of runoff period there. I was on the floor of the CBOE during that, and as you recall, during that period, it was pretty much every day there was a new headline. Bush is in the lead. No, Gore is winning. The recount's going this way. And these were two very diametrically opposed candidates in a lot of different issues, including economics. So what we saw was effectively the market rallying one day off the news, market selling off the next day off a different headline, and vice versa. That injected a lot of volatility into the marketplace. So I think the better part of a month or so is how long that went on. So that was kind of I would hope I hope we don't see something like that again in the near future. That's kind of the apex of what I would think of in terms of injecting a sustained amount of volatility into the marketplace. And the closest I could think to something like that happening this cycle, Randy, would be something along the lines of, again, two very diametrically opposed candidates. So in this case, you probably have to assume a Trump on one hand and then maybe a Sanders on the other. So two very much different breeds from a political spectrum, and have the election be very close going into the actual election day. Like polls are statistically tied, and then that might be something that would inject a lot of structural volatility in terms of whatever one wins is going to be a very different outcome for the marketplace. But in general, I think you can also view on a 10,000 foot perspective, you can kind of view elections, that period, as kind of like any other big event risk in the marketplace, like an earnings or a crop report or whatever type of thing, Fed announcement. There's going to be that kind of injection of implied volatility into the marketplace. I kind of refer to it as that balloon. The balloon keeps filling and filling with volatility premium. And then, unless something crazy happens, once the event is over, that balloon tends to pop and that premium comes out of the marketplace. And it kind of depends on how much is going on with those candidates, how contentious it is, and some other factors at play in terms of polling and everything, in terms of how much volatility is going to be injected into that time frame. But I think if you view it on that kind of framework, I think you'll have a decent understanding. But I don't know, Randy, are you, first off, what is your general 10,000 foot answer to Mr. or Mrs. JBiggs here? And then B, what would be your hypothetical scenario for the most type of kind of volatile type of election cycle we could have this time?
Well, I do remember your example going back to 2000. I mean, it was also true that was right around the time that the kind of bear market was getting going. So it's hard to, sometimes it's easy to look at one event and say that really was the result. But I do remember that. And I think it was very volatile. And absolutely, when the market's volatile, options are gonna respond accordingly. I think my biggest scenario that would cause a lot of risk is not whether or not Bernie Sanders, let's say if he were to win, who's obviously a committed socialist on one side, versus someone like Trump, who is debatable where he is on the spectrum, but or at least where he admits he's on the spectrum. I think the biggest deal was a Bernie win, or a close win, or a contested win, and the House, one or both of the houses, the Senate or the House going, flipping to the other side. So if the Democrats were to take over everything and Bernie were to win slightly, that would be huge, because now you're really looking at something that could make a tremendous negative effect, in my humble opinion. The change he could do. I mean, if Bernie Sanders got elected today and the Republicans kept control of the House and the Senate, I think Bernie Sanders wouldn't do anything other than executive orders for the entire 4 years. I don't think he could really get anything passed. So, I know that sometimes people think that, when you've got kind of a divided House, it makes it more calm. But that would be my scenario.
Yeah, it's true. He mentions presidential cycles, but we didn't even talk about the congressional elections and everything else, and how that's what I mean by there's a lot of moving pieces to this. A lot of them have to fall into place to make it a really, really, truly volatile event. But still, yeah, generally it does have that same type of event risk pattern. But again, it's gonna change depending on the cycle and what's going on and how the congressional race is heating up, and all sorts of other fun moving parts, which is what makes it fun. What keeps all the political pundits employed, at least through November or so here here in the States. I'm sure a lot of our international listeners, by the time they hear this, by the end of the year, they'll be so tired of hearing about electoral stuff. So we'll try to keep it to a minimum, but this is definitely not the last time we're going to talk about it here on the show, or certainly indeed on the network. Let's see, another one here. This comes from Alan Riggs. Randy, this one's right. This is actually for you. He says, hey, from Alan Riggs says, there seems to be a volume of data recently about the effectiveness of selling weekly instead of monthly premium. Does the team at Swan utilize weeklies for any portion of the DRS? If not, have they considered incorporating them in the future? Randy, this is obviously referring to a lot of the data we've cited on this show recently, as well as some other programs on the network coming out of the SIBO and other outlets, kind of comparing and contrasting selling monthly premium versus the very popular weeklies and how that compares over a total premium harvesting perspective, as well as from a total drawdown perspective, a risk perspective, a lot of other ways. And the data seems to be lining up pretty squarely on the side of the weeklies. Now, there are a few caveats in there depending on which product you're looking at, et cetera, but it seems like, and certainly coming out of the SIBO conference, which was about a month before yours, I think, the risk management conference, almost you can sum up that entire event in writing weeklies. That was kind of what everyone was talking about at that event, and that's what all the data was pointing to. So I'm kind of curious, and certainly our friend Alan is here as well. What do you guys think of the weeklies, and do you have any plans to maybe incorporate them in the future?
Well, Swan does not utilize weeklies on our main component of our income strategies. I think we do use them occasionally on some of our shorter term trades. You know, we have this kind of, Swan has a long-term track record that goes back to July of 97. You know, fundamentally, we stick to what works, our track record, what we're explaining, and trying to get advisors and clients to actually use. Part of that is them understanding and not getting whipsawed around. So the biggest argument against using weeklies for us would be just the longevity of our track record, as well as not having as much trading in individual clients' accounts and getting, it's just, there's some negative connotations in the cost structure of trading around that. But, conceptually, I don't disagree with some of the research and some of the stuff that people have done. Practically, it makes it a lot harder. It just goes back to, when you sit in someone's on a weekly or a daily basis explaining how the strategy works, getting into some of those complex or the more frequent type of trades is, quite frankly, it's harder to explain and harder for clients to understand. Therefore, it's not necessarily going to make it in the kind of strategies that we implement. Now, being in a hedge fund, if you were operating a hedge fund and you had no visibility and people didn't see what you were doing and you could pretty much do whatever you want, people just looked at the bottom line at the end of some period and they judged you based on that, then I guess that's more suitable for the weekly type of strategies. But based on our strategy, it's probably not the most ideal scenario.
Yeah, one of the biggest pushbacks I've always seen from a lot of advisors when you talk to them about options, when we initially approach them, is the time commitment. They say, I'm too busy. So getting them to bite on to a monthly type strategy is difficult enough. Now you can come up to them, even with all this data and showing the efficacy. A lot of them say, well, I just don't have time to do these on every week as opposed to every month. Again, if your advisor says that, maybe you want to find someone who change up a little bit, because it can be an effective strategy. But yeah, that's definitely one of the big pushbacks in the asset manager advisor space is time and finding a way to incorporate options at all, let alone on a weekly basis. But again, as more of this data comes out, I'm sure that conversation is going to continue. And also, just the popularity of weeklies is starting to impact how options perform overall, as a lot of the liquidity migrates from the monthlies into the weeklies. It changes how things work a little bit. So seeing how more of that evolves over time and more data starts to analyze that might be interesting. It might start to change the dialogue a little bit as well. All right, I think we got time for one more here. Randy, this one looks kind of interesting. This comes from Nathan Jones. He writes, I've always been intrigued by options. Well, glad to hear it. You're listening to the right show, Nathan. He goes on to write, and as I expand my client services, I would like to incorporate them. I've listened to your programs and reviewed the material provided by the OIC advisor team. I understand the mechanics of the strategies. At this point, I find myself hung up on the starting point. What should be my initial objective when using options? Do you view them primarily as a hedging and risk management tool, or primarily as an income generating tool? Also, when you present them to potential clients, how do you categorize them? Thanks. I'm looking forward to finally pulling the trigger. Well, this is an interesting one. I'd imagine a lot of our listeners are in a similar boat to Mr. Jones here, Randy, in that they're kind of they're getting lured a little bit to the dark side. That's why they're checking out a show like this. They want to start learning about some of the things we're talking about here. Maybe they've heard some of our previous episodes and they're starting to think about, I could probably do that. I could probably buy a put if I do it this way, and I could probably sell a call if I structure it that way, and starting to get over some of that initial fear and some of that initial reluctance. But yeah, how the objective, that's kind of interesting. Again, that's going to probably depend on the advisor. If he's a long-only equity guy, I think the hedging and risk management is certainly going to be a huge component of that, because that's providing a large value added of that. But almost as a counterpoint to that, you're going to want the income to help pay for their protection. So a lot of times with advisors, those are kind of two sides of the same coin. That's why I've always said on this show, the collar is kind of that holy grail position for financial advisors, because it combines both aspects. It utilizes the income portion to protect, to pay for some or all of the protection. And again, as we've discussed here on this program, there are many different ways you could construct it. You can go longer term, like Randy, you guys at Swan do with the protection, and then use shorter term to pay for it. You can go maybe middle of the road, maybe 6 months or something along that time frame, and short term, maybe even in the weeklies to pay for it. There are a lot of different ways you could construct that collar to really suit yours and your client's needs. So that's why I kind of like it. I kind of like it as a very adaptable tool for a lot of advisors out there. But I don't look at them as either or, Randy. Maybe you do. I'm not sure. I'll like to get your points, your thoughts on this. But I kind of view them as very much complementary to each other. This is a good question for you as well. How do you present these to clients? When you guys go out there, Randy, and you're talking DRS, or maybe even before you even get to that point, if you're just talking options, how do you categorize them to potential clients? Are you going out there and knock on the door and saying, "Hey, I got something for your alts allocation"? Is that how you guys get the conversation started, or how do you guys get the ball rolling over there?
Well, first of all, we don't think it's either or. Also, we sell it as a combined total return, absolute return type strategy. And in fact, when I use the presentation, we talk about the hedge of the underlying, let's say ETF, whether it's S&P or emerging markets or the various other products that we have. And we talk about the concept of the income as really hedging the hedge, right? When you commit to, a certain percentage of the portfolio is going to be allocated to long dated put options to underlying hedge the portfolio. Selling short-term premium is offsetting some of that risk in multiple ways, right? Obviously, you've got some volatility risk. You've got some time decay or theta risk that you're trying to offset. So we sell it as a joint package. We never go into a meeting or a conference saying, this is the way we fit. We get asked that all the time. Where do you guys fit within a portfolio? I'm always very frank and say, look, I designed the strategy, quite frankly, to replace a traditional 60-40 portfolio. My fundamental thesis going back to 1997 was, the asset allocation model is based on correlation coefficients staying somewhat diversified and moving in opposite directions at different points of the business cycle. And if you've got something that ultimately moves together and there's no guarantee they're not going to move together, I think 2008 somewhat proved that everything was going down in value. And therefore, you want something that's inversely correlated, that is going to be inversely correlated. That's what you end up with a hedge strategy. And so, yeah, it has to be a combined approach. I don't know how many clients would really want to sign up for us and say, hey, I want to buy insurance and I know it's going to cost me a lot. It's really going to drag down the portfolio and during bull markets, and don't worry about it. I know it's going to work out in the end. I mean, that doesn't really happen very often. They like the income component. They like the fact that although it doesn't help us match the upside of the market during bull markets, we think over a full market cycle, depending on the severity of the bear market, we think the hedge will pay for itself in a lot of cases. Our experience is it's been that way, and we use the, quote, option income to really provide alpha of our strategies. So that's the way I explain it. That's the way we sell it. That's the only way I think you really can sell it. We have clients that have hired us just to do the income components alone and don't want the underlying hedge. But I don't think we've ever really hired someone to just do the hedge without the income alone.
Yeah, that's kind of the less sexy for a lot of people. Hey, I'm going to add, I don't know, about 8% a year to your total returns. It's a hard thing to sell. It certainly has value, and certainly in a down market, it could help you outperform. But yeah, you're right. That's kind of a hard thing to lead with. You got to have that income component to jazz it up. And I would definitely encourage you. Great question, Nathan. A good. I encourage you to look. I'm looking forward. Let us know how it goes. When you do pull the trigger, I want to hear back from you, see how it went. I would encourage you too, not to, if you are going to pull the trigger, to actually pull the trigger. And we see sometimes some funds and some people, they dip their toes in, they do like a 3% or 5% alts allocation, and that's where they do all their option stuff in there. And that's not really going to move the needle. That was kind of another big takeaway from the CBO conference, the risk manager conference I went to, was that you really, talking to they had a lot of pension fund plan guys up there and others up there, and CIOs from different funds, and they all said, kind of agreed on the same thing. You got to really do at least 20% to really start seeing any material difference. I mean, if you're trying to hedge and you're only hedging a tiny portion of your portfolio, it's not going to do anything for you. Same thing with the income. If you're doing such a nominal amount of income compared to your large portfolio, it's not really going to move the needle for you. You're not going to like what options do for you. You may end up just washing your hands of it. You have to dive in with at least some sort of meaningful percentage to kind of see the impact for yourself. Then be like, okay, I understand this now. Maybe I want to expand it to my whole portfolio, to overlay the whole thing, or whatever the case may be. So yeah, don't just do a 5% or whatever and think it's going to be the magic panacea for all the ills of your portfolio. It doesn't work that way, unfortunately. I wish it did, but it doesn't work that way. All right, that's unfortunately all the time we have for your questions. It's also all the time we have for this episode of the Advisor's Option. I love our listeners, Randy. They pull us in all kinds of interesting directions. Maybe we should have a whole question episode, because you guys just you bring it. I love hearing what you guys want to know about. Keep those questions coming. Of course, all the usual suspects. You can hit up Randy and his team over there at their site, and Swan Global Investments, of course, or hit us up on the website, theoptionsinsider.com, or via Twitter. We're at Options, of course, Facebook, The Options Insider, or we're even Options Insider on StockTwits, or the old-fashioned way, email, questions@theoptionsinsider.com. No shortage of ways for you guys to reach out to us. Of course, you can hit us all it's all baked into the app as well. So if you're listening via the app, you can hit us up there as well. As you're listening, hit that feedback button. You can send us your questions as you're listening, which is always kind of fun. And Randy, before we go, we mentioned at the top of the show, you guys have that new URL, swanconferences.com. So listeners should check that out if you want to check out what you guys are cooking up in the event space. And what else is coming down the pike from Swan that may interest our listeners, Randy?
Well, really, the DRS 22 between now and the end of the year, I think that's the main component. Of course, we're going to keep our normal schedule in terms of our monthly newsletter and our quarterly newsletter and the blogs and research that Micah and Mark are writing up on a continual basis. So I really think it's those events. And like I said, we're probably going to get pretty close to your area if we're going to do 22. So you can imagine breaking everything up, breaking the U.S. up into 22 areas, and we're not doing one in Hawaii or Alaska. So that gives you something that's probably no more than a Southwest flight away.
Yeah, I'm definitely impressed with the scope. 22 events. I know it takes to put on one event, let alone 22. And if they are smaller in scale, the logistics alone is impressive. So check it out, listeners. SwanConferences.com. Or, of course, you can head on over to the mothership, SwanGlobalInvestments.com, to check out the things we were talking about earlier, like the good, the bad, and the ugly, and all the info on the DRS and all the other fun stuff. And, of course, they couldn't be here today, but also check out our friends over there at the OIC. OptionsEducation.org is the home for them. Click on that Advisors tab, top right corner of the homepage, if you want to get access to that. There is a login there, but once you get past that login field, you get access to all this great data we're always talking about on the show, like their data analysis on efficacy of collars across a variety of market conditions. That could be useful when our friend there, I believe his name was Nathan. Yes, Nathan is talking to his clients about using options. That data may come in handy. So a lot of great stuff over there. OptionsEducation.org to learn more. And on behalf of the OIC, who couldn't be here, and of course Randy and the team over there at Swan, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing to the show. And of course, for sending in such great, many, and varied questions. Keep them coming. We love to hear all the things you guys are thinking about. And we'll see you next time for more of The Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.